Silver just pulled off a move that most market veterans only see a handful of times. After printing above $121 an ounce, spot silver flipped and fell roughly 9.2% in a single session, sliding to about $80. That is not a slow reprice, that is a trapdoor. And what makes it so consequential is the time compression, not months, not weeks. For years, the comfortable belief was that silver could be jumpy, sure, but that it would never unwind like that without a clean macro shock. The narrative always says it needs a recession headline, a central bank pivot, a geopolitical jolt, something obvious enough to justify the candle. This is where the information asymmetry shows up. Institutions do not wait for the headline. They watch the plumbing, positioning, margin schedules, warehouse flows, delivery mechanics, the points where leverage becomes fragile. Most people see the candle. They don't see the pressure building inside the pipe. When the pipe bursts, the candle is already gone. Here's the pattern interrupt. The move you just watched was not primarily an opinion vote on silver's long-term value. It was a mechanical event. It was the system exposing where leverage was hiding, who was positioned early, and which side of the trade was surviving on borrowed collateral. Welcome to Silver Signal. This is the channel where we decode what matters before it becomes the easy headline everyone repeats. The goal here is simple: make the market's mechanics understandable so you can read the setup, instead of chasing the aftermath. And if you want, drop a comment with where you're watching from, because silver is one of the few global markets that trades everywhere but feels personal everywhere. Now let's reconstruct the scene with forensic detail. In late January into early February 2026, silver accelerated into a near vertical rally, pushing above roughly $121 an ounce. Moves like that rarely happen in a vacuum. They usually involve a blend of momentum buying, options hedging, and futures participation, where traders try to capture the move with less cash than the metal is worth. Then, almost as quickly, the reversal hit. In one session, silver fell about 9.2% to around $80, a brutal drop relative to what most people expect from a major precious metal outside of a full-blown macro crisis. That kind of reversal creates a strange psychological fog. Bears feel nervous because collapses that fast can also snap back. Commentators scramble to locate a narrative. But the market doesn't wait for narration, it just clears. And the clearing process leaves fingerprints. One of the cleanest fingerprints is what happened in futures participation. COMEX silver futures open interest fell to about 143,180 contracts on February 3rd, down from roughly 156,637 the week before. That's an 8.59% decline in a week. In a market like silver, that kind of drop is often the difference between a normal pullback and a liquidation event. It signals that positions were being closed, not merely shuffled. So here's the central mystery. If silver was strong enough to race above 121, why did it collapse so fast? Why didn't it grind sideways? Why didn't it bounce at obvious technical levels? Why did it behave like a crowded trade hitting a wall rather than a new bull market taking a breath? To answer that, you have to stop thinking like a headline reader and start thinking like a clearinghouse. There's a hidden pattern in silver that repeats with almost uncomfortable consistency. When the market becomes crowded on one side and volatility spikes, the infrastructure tightens. Futures exchanges and clearing organizations raise collateral requirements. Brokers tighten internal risk limits. Margin desks become less tolerant. Not because anyone wants drama, but because the system is designed to reduce counterparty risk precisely when price moves become unstable. In the volatility window around this reversal, reported margin adjustments included silver margin moving from around 11% to about 15% for non-heightened risk, and from roughly 12.1% to around 16.5% for heightened risk. Those are not abstract percentages. They are an immediate cash demand. If you're leveraged, a sudden margin increase is not a suggestion. It is a bill due right now. And this is the part most people miss. Margin changes do not care about your conviction. They do not care about your thesis. They do not care that you were right on the bigger picture. They only care whether the position is funded. If you've never lived through a margin shock, here's what it feels like. You wake up holding the same position you held yesterday. You didn't add size. You didn't take extra risk. But overnight, the required collateral rises. So you either wire more funds, reduce the position, or sell something else you own to cover it. When lots of participants face the same choice at the same time, markets create forced sellers. Forced sellers do not negotiate. They hit bids. That is why an apparent trend can reverse like a light switch. The reversal is not the market deciding silver is worthless. It is the market discovering who cannot afford to keep holding. Now step back into history, because this script has appeared before. In 1980, silver famously surged and then snapped back hard as rules changed and leverage could not survive. In 2011, silver ran into the high 40s and then reversed with speed that shocked anyone who believed strong trends only correct gently. The details differ across decades, but the structure rhymes. A fast rise attracts leveraged participation, volatility spikes, collateral requirements rise, and late positioning gets purged. There is an additional historical nuance that matters. In episodes like 2008 and 2020, you also saw markets sell what they could, not what they wanted to. In stress, participants liquidate liquid assets first. Silver is liquid. That can create a paradox where a metal tied to hard asset narratives falls during the very windows when people talk about fear. That paradox is not a contradiction. It is a liquidity event. Now we talk about the players, because this is where coverage usually gets vague. Silver is not one crowd. It's layers with different motivations and different constraints. First, the exchange and clearing layer, CME and the COMEX ecosystem matter because they set the collateral reality for a huge portion of speculative exposure. Their margin frameworks are built to keep the system stable. When volatility expands, margins tend to rise. That reduces leverage. It forces position reduction. It changes behavior. Second, the broker layer. Even if an exchange sets a margin level, brokers can require more. They do it to protect themselves. During violent moves, brokers may raise house margins, reduce allowable leverage, or force position reductions if clients are close to risk limits. That means the effective tightening can be larger than the headline margin figure. Third, the institutional hedge layer. Banks, large funds, and commodity trading firms often run portfolios where silver exposure is hedged against other positions. They may hold futures while offsetting with options, or hold spot while offsetting with forwards. Their risk is managed, their funding is planned, and their timelines are longer. They can survive a margin hike without panic. Fourth, industrial and physical participants. Manufacturers, refiners, and wholesalers care about availability and cost, not chart patterns. They can be buyers on dips if they need inventory, or they can step back if they already covered needs. Their behavior can create the physical signals that sometimes diverge from paper price. And then there is the regional layer, which is crucial in silver. Price discovery is not only one venue. It is a conversation between venues. Western futures markets can be dominated by financial flows, while Eastern markets can reflect different demand and inventory dynamics. When those diverge, dislocations are born. This is where one institutional story stands out, because it shows that not everyone was trapped by the reversal. Reports indicated that China's Zhongkai futures carried a bearish position on the Shanghai Futures Exchange, equivalent to roughly 484 tons of silver, around $1.5 billion notional, by February 2nd, 2026. As the downdraft hit, that position reportedly produced profits of roughly RMB 3.6 billion, about $519 million US dollars. Pause on that number. $519 million is not a retail win. It is what happens when a large, well-funded participant reads the stress signals early and positions for the snapback while the crowd celebrates the breakout. And notice the timing. By February 2, the position was already there. That matters because it suggests anticipation, not reaction. It doesn't imply omniscience, it implies process. Institutions that win in volatile markets often win because they watch structure, not sentiment. Now we arrive at the dislocation, the place where two sets of data tell opposite stories. On one side, the paper market signaled liquidation. The open interest dropped to 143,180 contracts, down from 156,637, tells you participants left. The margin hike figures tell you the cost of staying rose. The price drop tells you forced sellers found fewer bids. On the other side, physical indicators did not scream collapse in the same way. End January 2026, data put silver in LBMA vaults around 27,729 tons, down about 0.3% month over month. That's a mild decline. It's not a flood of metal dumping into storage. It's not a dramatic restocking. It is steady, slightly lower inventory while price was doing gymnastics. Then look at the east-west contrast in warehouse signals. Early February data showed a sharp daily drop in Shanghai Futures Exchange. Silver warehouse stocks from about 412.459 tons on February 5th to roughly 349.9 tons on February 6th. A drop like that does not automatically mean shortage, and it does not automatically mean demand exploded. But it is a physical flow event. It is a sign that metal was being moved or reclassified in a way that matters to real-world availability. So you have paper liquidation and physical flow hints living in the same week. That is, the dislocation. Two markets, two stories. This gap cannot persist forever. Historically, when paper prices diverge from physical conditions for long enough, one side adjusts. Either physical availability loosens and supports the paper narrative, or paper prices rebound and catch up to physical tightness. Which adjustment happens depends on what the data keeps doing after the liquidation phase ends. Now let's put the evidence in a clean chain, because clarity matters more than excitement. First, price printed above $121 and then fell to around $80. with roughly a 9.2% one-day drop in the reversal window. That is the visible event. Second, participation shrank. Open interest dropped to 143,180 contracts on February 3rd, down 8.59% week over week. That suggests positions were being closed, not simply rebalanced. Third, funding costs rose. Margin adjustments reportedly moved silver from around 11% to 15% for non-heightened risk, and from roughly 12.1% to 16.5% for heightened risk. That change increases cash demands and forces liquidation among the most leveraged. Fourth, institutional positioning showed asymmetry. A bearish position equivalent to roughly 484 tons, around $1.5 billion notional, was reportedly in place by February 2nd, and profits of about RMB 3.6 billion were reported. That tells you at least one large participant was prepared for the reversal. Fifth, physical indicators were not perfectly aligned with the panic narrative. LBMA vaults showed about 27,729 tons at end January, down only about 0.3% month over month, while Shanghai warehouse stocks showed a notable daily drop from 412.459 to 349.9 tons between February 5 and February 6. That is a set of facts that points to one conclusion. The reversal was driven by structure and positioning as much as by any narrative. Now, the mechanism. How is a reversal like this executed in practice without anyone needing to push a button? It starts with volatility. A market moves fast. Options, hedgers adjust. Futures traders add leverage. Stops tighten. The crowd becomes sensitive. At that point, risk managers act. The exchange adjusts margins. Brokers raise house requirements. Some funds hit internal drawdown limits. Some traders get margin calls. Some are forced to reduce. The forced reduction becomes selling. The selling hits a thinner order book because many buyers step back during chaos that pushes price lower. Lower price triggers more margin calls. More margin calls trigger more selling. This is not mystery, it is feedback. A simple analogy helps. Imagine a long line of dominoes where each domino represents a leveraged account. When price drops a little, the first domino falls, a margin call. That margin call causes selling, which knocks over the next domino. In a calm market, the line is spaced out and the dominoes are heavier. In a crowded, leveraged market, the dominoes are packed tight and light. The cascade is faster. The fundamentals did not get a vote until after the cascade. Fundamentals show up when forced selling ends and real demand is willing to absorb supply. That brings us to what it means going forward. The inevitable outcome is not a specific price target. The inevitable outcome is that after a leverage purge, the market's next phase is determined by whether real-world constraints continue to diverge from paper behavior. If the liquidation phase is still ongoing, you tend to see continued declines in open interest and continued volatility spikes. If the liquidation is mostly done, you tend to see volatility compress, price stabilize, and participation either rebuild or stay low as the market resets. So the forward analysis becomes a set of conditional scenarios. In a conservative scenario, silver stabilizes in a wide range. The market digests the margin shock, open interest finds a floor, and price becomes choppy as participants rebuild positions carefully. In this scenario, the big story is time, not drama. The market needs breathing room to reset risk. In a moderate scenario, physical flows and steady demand begin to matter more after forced sellers are gone. The dislocation narrows. Price recovers portions of the drop over time, not because of hype, but because the absence of forced sellers lets normal buyers return. In a more aggressive scenario, the liquidation flush creates an air pocket that eventually snaps back. If physical tightness indicators keep flashing while paper selling exhausts, you can get sharp rebounds that surprise everyone who assumed the reversal proved the move was fake. Historically, markets that purge leverage can rebound quickly when the underlying demand is still present. Again, the point is not to promise an outcome. The point is to recognize what typically follows a mechanical flush. So what should be watched? Not a list of opinions, a list of signals. Watch whether futures open interest continues to shrink beyond the February 3rd level of 143,180, or whether it begins to rebuild from that reduced base. Continued shrinkage usually means the purge is still active. Rebuilding can mean fresh collateral is stepping in. Watch whether margin policy remains elevated and restrictive, because persistent high margins change the character of rallies. When margins are high, rallies tend to be less explosive because leverage is expensive. When margins loosen, leverage can return. Watch inventory signals as a stress gauge. LBMA vault totals around 27,729 tons, and the month-over-month change tell you whether the London storage picture is tightening or loosening. Shanghai warehouse moves like the February 5 to February 6 drop from 412.459 to 349.9 tons tell you whether metal is being moved in, ways that could matter for regional availability. Watch whether institutions appear to extend hedges or reduce them. But you can infer it through how volatility behaves, how liquidity behaves, and whether price action becomes orderly or remains fragile. Now, let's address a subtle but critical point. This reversal can fake people out in both directions. It can fake out the late bull who thinks a breakout guarantees follow-through. In leveraged markets, breakouts can attract leverage precisely at the wrong time. The crowd buys the confirmation candle. The system raises the cost of holding. The crowd becomes the fuel for the reversal. But it can also fake out the late bear who thinks the crash proves the whole thesis was wrong. A mechanical liquidation event is not a referendum on the long-term story. It is a funding event. If the liquidation phase ends and physical demand remains, the rebound can be sharp and humiliating to anyone who mistook forced selling for a permanent new equilibrium. That's why the calm, adult approach is to treat the reversal as information. The market just revealed where it was crowded. It revealed that leverage was heavy enough to be vulnerable to margin tightening. It revealed that at least one major institution was positioned for the downside, with a bearish posture equivalent to 484 tons by February 2nd, and reported profits around RMB 3.6 billion. It revealed that physical data did not instantly collapse alongside the price. This is not opinion, this is pattern. And the pattern has a moral, if you want one. The divide in markets is rarely intelligence, it is instrumentation. People who get faked out are not foolish. They are watching the wrong layer. They watch the price line and assume it contains the entire truth. The people who stay oriented watch the constraints. Margin, open interest, inventory, and cross-venue behavior. They understand that the market is a machine. Price is the output, not the input. That's also why institutions tend to move first. They are not always right, but they are usually early because they track structure. Retail tends to move last because it waits for the story to arrive in plain language. By the time the story is clear, the move is often finished. So don't treat this reversal as a magic signal that silver is over, and don't treat it as a guarantee that the rally resumes tomorrow. Treat it as what it clearly was: a leverage purge triggered by volatility and collateral tightening, colliding with a market that still has real-world physical dynamics underneath it. If the data keeps diverging, the dislocation becomes the story. If the divergence fades, the market returns to normal behavior. Either way, the people who avoid getting faked out are the ones who keep their attention on the plumbing when everyone else is staring at the candle. One last contradiction is worth holding in your mind. In the same week that commentators argued silver was too extended and too risky, the very infrastructure that made it risky was also making it harder to speculate. Higher margins reduce leverage, which reduces the size of the next wave of forced selling, which can quietly rebuild stability. That is why the cleanest reversals often happen near the moment the public becomes most confident in its explanation. The market doesn't reward certainty. It rewards preparation for multiple paths and attention to what is changing beneath the surface. When you hear experts disagree, don't pick a personality, pick a metric, and let the next changes in. Open interest, margins, and inventories decide. This is Silver Signal, where we decode what matters before its headlines. If this connected dots you hadn't seen, you know what to do. Because the question isn't whether silver moves. Silver always moves. The question is whether you're reading the mechanics before the move reads you.